Welcome to the podcast, Surviving AI with Carlo Thompson. And before we get started today, please remember to subscribe and like the show so you never miss an update. Today, we are embarking on a massive, highly requested deep dive into, well, the financial and technological earthquake that is currently shaking the markets. The title of today's deep dive is The AI Bubble Deflation: Economic Collapse or Correction, What Experts Predict for 2026.
Yeah, and it is the absolute defining question of the year right now. I mean, it is keeping venture capitalists, everyday retail investors, and corporate executives awake at night. We are looking at a landscape that feels completely unprecedented, but also, strangely familiar at the same time.
Exactly. And our mission for this deep dive is to give you, the listener, a comprehensive, unflinching look at the financial, labor, and technological realities of artificial intelligence as we navigate the turbulence of 2026. We're analyzing a multi-trillion-dollar industry here.
Right, multi-trillion.
Yeah, and the central question we really have to answer is this. Is this massive AI bubble actually popping and bringing the broader economy down with it, or are we just witnessing a necessary, painful, but ultimately healthy market correction?
That's the billion or, I guess, trillion-dollar question.
It really is. And throughout this deep dive, my focus is going to be intensely practical, very action-oriented. We need to figure out how you can position your portfolio, your career trajectory, and your business strategies to not just survive this environment, but to actually thrive in it. Because there is a massive opportunity hidden in all this chaos.
And I will be taking the role of the realist today, the skeptic, if you will. Because for the last, 3 years, the hype has been just utterly deafening.
Oh, totally deafening.
Right? We have been sold this narrative of inevitable frictionless progress. But we really need to look past the slick press releases and the keynote presentations. We are going to question those narratives, highlight the very real systemic risks, and look at the cold, hard data. We're talking about actual job losses, massive profit deficits at the foundational AI companies, and infrastructure bottlenecks that, frankly, nobody wants to talk about at those flashy tech conferences in Silicon Valley.
Which is exactly the balance we need today. Because whether you are prepping for a boardroom meeting later today where you have to justify an AI budget, whether you're managing your own 401k and wondering if you should sell your tech stocks, or if you're just trying to navigate your career path in a world where software can suddenly write its own code, this deep dive is designed to cut straight through the noise of 2026.
You need the facts.
Yes, you need the facts, you need to understand the mechanics of what is actually breaking behind the scenes, and you need to know how to act on that information. Okay, let's unpack this, starting with the absolute highest level, the macro view of the stock market. We really have to talk about the 2026 valuation paradigm. Capital Economics recently put out a genuinely stark prediction that has just sent ripples through the entire financial world.
It was a bombshell report.
It was. They are stating that the AI-fueled stock market bubble is going to burst starting right now in 2026.
Yes, and their analysis is incredibly sobering if you actually look at the underlying mechanics. They projected that the S&P 500 might hit 6,500 by the end of 2025, which, it largely did.
Driven almost entirely by a handful of stocks.
Exactly. Yeah. Driven entirely by the sheer unadulterated momentum of a few massive technology stocks. But their thesis is that starting in 2026, those spectacular gains are going to unwind precipitously. And it's not just because people suddenly decide AI is a fad. It's structural.
Yeah.
They are pointing to rising interest rates and a higher, stickier inflation rate that will essentially act as gravity on these sky-high equity valuations.
Let's break down why inflation and interest rates act as gravity for tech stocks, just so we're all on the same page here. When you buy a tech stock at a massive premium, you're basically buying the promise of huge profits 10 or 15 years in the future.
Right, future cash flows.
Exactly. But if interest rates are high today, the mathematical value of those future profits shrinks drastically. You could just put your money in a risk-free bond and get a guaranteed return today. So when Capital Economics says inflation is sticky, they are saying the easy money era is over, which means the justification for these astronomical tech valuations evaporates.
Precisely. And what they're fundamentally arguing is that the era of American exceptionalism in equities might actually be coming to an end.
Yeah.
For the better part of a decade and a half, the strategy for global investors has been really simple. Buy the U.S. stock market, specifically U.S. tech, and ignore the rest of the world.
Because it outperformed everything else.
It outperformed everything.
Yeah.
But Capital Economics is warning that this massive AI-driven concentration in U.S. equities has stretched that rubber band as far as it can possibly go. When it snaps back, the reallocation of global capitals is going to be violent.
And they aren't the only heavyweights sounding the alarm. We have to look at Bridgewater Associates, one of the largest hedge funds in the world, and specifically the warnings coming from its founder, Ray Dalio.
Dalio has been very vocal lately.
Very vocal. He's predicting an early 2026 stock market storm. And he ties this directly to AI-driven debt bubbles. But I think what's really crucial here, what you can actually learn from, isn't just what Bridgewater is saying in interviews, it's what they are actually doing with their billions of dollars. They have executed a massive portfolio pivot that completely contradicts the mainstream narrative.
It is a fascinating pivot. They aren't just trimming their positions on the edges, they are slashing their stakes in the absolute titans of the AI boom.
Give us the numbers on that, because they're wild.
We are talking about cutting their holdings in Meta by over 46%. They reduced their Alphabet position by 40%, and they even cut Microsoft by 10%. These are the companies that completely defined the 2024 and 2025 bull run.
But notice what they aren't doing. They aren't just fleeing to cash and hiding under the mattress. They are actively surging investments into a very different profile of company. They increased their stake in Block by a staggering 960%, and they bumped up their position in Oracle by 361%.
Which tells you exactly how they are reading the board.
Right. They are repositioning for a very specific type of market reality, one that values underlying financial plumbing and specific enterprise applications over consumer-facing AI chatbots.
It is a purely defensive rotation, and Dalio himself has explicitly stated that the current levels of investment in AI are very similar to the dot-com bubble of the late 90s and early 2000s. And he is not alone in the financial establishment. You have Jamie Dimon, the CEO of JP Morgan, along with the Bank of England, raising severe coordinated alarms about a sharp, painful correction.
And they are all pointing to the same bottleneck, right?
Yes, the core issue they are pointing to is the infrastructure cost. We're going to get deep into the specific numbers shortly, but fundamentally, if the cost of building out the servers, the power grids, and the massive data centers for AI outpaces the actual dollars and cents it generates in revenue, the math simply stops working. It becomes a black hole for capital.
Okay, I hear your skepticism, and I know the dot-com comparison is the easiest one to reach for when we see these numbers. But let's be real for a second. Isn't that exactly what the pessimists said about the internet in 1999?
Well, yes, but...
Yes, the financial bubble popped in 2000, and a lot of terrible companies like Pets.com went to zero. But the underlying technology still completely changed the world. The internet wasn't a fad. As an investor or a business leader, if I just sit on the sidelines out of fear because Jamie Dimon is worried about infrastructure costs, I miss out entirely on the companies that become the next Amazon or Google.
That is a fair counterpoint. But it ignores the darker layer to the current 2026 situation, which is the shadow banking risk.
Ah, the shadow banking piece.
Right. During the dot-com bubble, the speculation was mostly in public equities, retail investors day trading tech stocks. Today, analysts are warning that a massive amount of risky, unregulated lending in the private credit markets, the shadow banking sector, is what is actually propping up these AI valuations.
Explain how that works, practically.
Private equity firms are lending billions of dollars to AI startups, entirely outside the purview of traditional banking regulators. If one major AI startup defaults on that private debt because their models don't generate the promised revenue, the contagion in that unregulated debt market could be incredibly rapid and entirely opaque until it is far too late.
Okay, the shadow banking doomsday scenario is definitely on the table, and it is terrifying. But let's counter that pessimism with the current perspective from Morgan Stanley and Goldman Sachs, because their analysts are seeing something very different in the data.
What are they seeing?
To them, this isn't a burst, it's a rotation. They argue the market isn't collapsing into a singularity, it's just getting smarter and more discerning.
How did they justify that, given the massive pullbacks we are seeing in the foundational tech stocks?
Because investors are taking their money away from the builders, the companies making the picks and shovels for the AI gold rush, and they are moving it to the adopters. Now, obviously, a builder like NVIDIA is still a behemoth. I mean, they recently hit a historic $5 trillion valuation, which is almost impossible to even comprehend.
5 trillion is a staggering number.
It's insane. But the smart money, the institutional capital, is starting to flow toward the adopters. These are the companies in traditional sectors, healthcare, energy, financials, logistics, that are taking the AI tools the builders made and using them to actually boost their profit margins, cut their operational costs, and drive real-world efficiency. It's about moving from the people pouring the concrete to the people actually opening businesses inside the new buildings.
I will concede that the data supports a shift, but it also reveals some stark geographic and sector divides that complicate that rotation narrative. If you look at the macroeconomic data from S&P Global Ratings, they show that AI-related exports remain incredibly brisk in 2026. The physical hardware is still moving.
Right, someone is still buying the chips.
Exactly. But this is creating massive tailwinds for regions outside the United States. It's benefiting emerging markets in Asia, countries like Malaysia, Thailand, and Vietnam. These nations are deeply integrated into the high-tech supply chain. They are manufacturing the cooling systems, the specific subcomponents of the servers, and the memory chips. They are seeing goods exports grow well above 10% year over year. So the boon is real, but the profits are dispersing globally, not just concentrating in Silicon Valley.
And if you look at the individual stock performances domestically, the divergence is absolutely wild. It paints a picture of a market that is deeply confused about where the value actually lives.
Oh, completely confused.
You have NVIDIA, with some analysts still stubbornly projecting a potential 32% upside and a $250 price target, despite its massive size. You have companies deeply embedded in the hardware, like Micron Technology, up over 342% from their previous lows. But then you compare that to the sluggishness of what they are calling the S&P 493.
The S&P 493, the rest of the index outside the Magnificent Seven tech giants.
Exactly. The builders have had their historic run, and while they might still eke out some growth, the rest of the market is holding its breath, waiting to see if the adopters can actually prove the ROI.
What's fascinating here is that to truly understand this macroeconomic anxiety, to understand why the S&P 493 is holding its breath and why Ray Dalio is running for the hills, we have to look at the microcosm of the company that started this entire frenzy.
OpenAI.
Yes. We cannot talk about 2026 without looking directly at OpenAI, because right now they are the epicenter of both the technological miracle we are living through and the potential financial black hole that could drag the broader markets down.
That is the perfect pivot. That divergence you just mentioned between the builders and the adopters is fascinating. But to really understand the anxiety driving this market, we have to look at the elephant in the room. We have to look at OpenAI's balance sheet.
And it is not pretty.
The leaked financial documents from OpenAI are, frankly, mind-boggling. We are looking at a projected $14 billion loss for the year 2026 alone. Let that sink in. $14 billion incinerated in 12 months.
It's unprecedented burn.
And it gets heavier. Their own internal projections expect a cumulative $115 billion loss by the year 2029 before they even sniff the possibility of profitability in the 2030s.
It defies traditional financial gravity. To survive this staggering burn rate, they are reportedly out in the markets seeking a historic $100 billion in funding, trying to justify an $830 billion valuation for a company that loses tens of millions of dollars every single day.
To put that $14 billion single-year loss into perspective, we have to look at historical mega projects. Think about the Manhattan Project during World War II, which essentially birthed the atomic age. That entire project, adjusted for inflation to constant $1996, cost roughly $20 billion.
So they are burning the Manhattan Project every year and a half.
OpenAI is burning through almost the entire cost of the Manhattan Project in 12 months. And it's not going toward paying scientists. It is almost entirely driven by physical infrastructure, the electricity to run it, and the sheer compute costs of training these massive neural networks.
Which brings us directly to the Stargate data center project,
Yeah.
which perfectly encapsulates the delusion versus the reality of 2026. Stargate was announced a couple of years ago with incredible fanfare and a seemingly impossible $500 billion promise.
$500 billion just for a data center.
Right. It was supposed to be the supercomputer to end all supercomputers, the physical manifestation of artificial general intelligence. But the reality on the ground today is starkly different. Currently, they only have about $52 billion in committed equity from players like SoftBank, Oracle, MGX, and OpenAI itself.
Wait, if they promised a $500 billion facility and only have $52 billion in equity, where is the other $450 billion supposed to come from?
Exactly the right question. The rest is supposed to be debt. They intend to borrow the difference.
Borrow $450 billion.
Yes, but as we discussed with capital economics and rising interest rates, that debt is becoming exponentially much harder and much more expensive to secure. No bank wants to underwrite hundreds of billions of dollars in loans for a data center when the underlying company is projecting a $115 billion cumulative loss.
This is where we have to look at the tactical risks of how this entire ecosystem is being funded. You've brought up this concept of circular financing before in your notes, and it seems like a massive systemic red flag. For the listener who isn't deep in the weeds of venture capital structuring, can you break down exactly how this closed loop is actually operating?
It is a precarious house of cards, and it is the single biggest systemic risk in the tech sector right now. Here is how the circular financing works in plain English. OpenAI is trying to build the smartest AI in the world. To do that, they need massive, unprecedented computing power. So they buy that compute time from a specialized cloud provider called CoreWeave.
Okay, OpenAI buys from CoreWeave, got it.
CoreWeave is thrilled, but to provide that massive compute, they need tens of thousands of specialized AI chips. So CoreWeave turns around and buys billions of dollars of GPUs from NVIDIA.
Okay, so far that just sounds like a normal supply chain. OpenAI buys from CoreWeave, CoreWeave buys from NVIDIA. What's the problem?
The problem is the incestuous nature of the capital funding it all. NVIDIA isn't just a supplier to CoreWeave. NVIDIA is a major financial investor in CoreWeave. They gave CoreWeave money, which CoreWeave uses to buy NVIDIA chips.
Oh.
Meanwhile, Microsoft is the primary financial backer of OpenAI, having poured billions into them. And in exchange, OpenAI commits to buying Microsoft's Azure cloud services. The money is just traveling a circle. Microsoft funds OpenAI, OpenAI buys from CoreWeave and Microsoft, NVIDIA funds CoreWeave, CoreWeave buys from NVIDIA.
It's like a snake eating its own tail. It artificially inflates the revenue of everyone in the circle.
Exactly. NVIDIA looks like they have massive sales, but they're essentially financing their own customers. If any one of those pillars experiences a demand shock, say OpenAI runs out of money and stops buying from CoreWeave, CoreWeave can't pay its debt to NVIDIA, and NVIDIA's revenue collapses. The contagion spreads instantly.
Have we seen any cracks in that yet?
We saw a terrifying glimpse of this vulnerability recently. Microsoft stock dropped 12% in a single day, erasing $440 billion in market value. Why? Simply because a report revealed that 45% of Microsoft's entire cloud backlog, the future revenue they promised Wall Street, is tied exclusively to OpenAI.
Oh, that's huge.
If OpenAI falters, almost half of Microsoft's cloud growth vanishes overnight.
That is a staggering vulnerability. It reminds me of the intertwined mortgage-backed securities in 2008, where one default cascaded through the entire global financial system because everyone was holding everyone else's paper.
It's a very apt comparison.
But here is the tactical counter-argument, and this is where I think the doomsayers might be missing the forest for the trees. What if the fundamental technology paradigm shifts before the financial burden crushes them? I was reading through the notes on what the industry is calling the DeepSeek moment that happened in early 2025, and this seems to flip the entire infrastructure argument on its head.
DeepSeek certainly shocked the Silicon Valley establishment.
It completely upended the narrative. DeepSeek was a Chinese-made model that proved you don't necessarily need a trillion-dollar data center and endless rivers of capital to achieve state-of-the-art results. They built a model that rivaled OpenAI's best for a fraction of the cost.
A tiny fraction.
Yes, and this triggered a massive pivot in the industry. The smartest builders are rapidly pivoting to smaller, cheaper models using highly efficient architectures. Two terms you will hear constantly now are mixture of experts, or MOE, and multi-head latent attention.
We should clarify what those architectures actually do, because they represent a fundamental departure from how OpenAI built GPT-3 and GPT-4.
Yes, absolutely. For the listeners, think of a traditional, older AI model, like a single, brilliant person who has memorized every book in the world, trying to answer every single question you throw at them.
The brute force approach.
Exactly. If you ask them a basic math question, the entire brain lights up, using massive amounts of energy to retrieve the answer. It's exhausting, it's inefficient, and it's incredibly expensive to run on a server. Mixture of experts, on the other hand, is like having a panel of highly specialized professionals. You have a math expert, a poetry expert, a coding expert.
Right.
When you ask a math question, a routing system simply turns on the math expert while the other 99 experts stay asleep. It saves a massive, massive amount of computing power and electricity. These architectures are leapfrogging the massive brute force models of the past.
And that technological shift is exactly what threatens OpenAI's current business model and makes their financial situation so perilous. We are seeing a structural pivot from what we call training time compute to inference-time compute. This is often referred to in 2026 as model deliberation. The new ethos in the labs is that slow is smart.
Break down the difference between training time and inference time compute. Why does that matter to the bottom line?
Training time compute is the brute force method we just talked about. It's feeding the entire internet into a massive data center for 6 months straight using gigawatts of power so that the resulting model can instantly guess the next word in a sentence the moment you type a prompt. That is what OpenAI spent billions on.
Right.
Inference time compute is different. Instead of spending all the money upfront on training, they're utilizing techniques like reinforcement learning with verifiable rewards, or RLVR. What this means is that when you ask the model a complex question, it doesn't just spit out the first answer it guesses. It pauses. Yes, it spends time thinking through the problem locally, running through different possibilities, verifying its own logic against known rules before giving you the answer.
Which is brilliant for the end user. I would much rather wait 10 seconds for an AI to actually think through a complex legal contract and give me a correct summary, rather than get an instant hallucination.
It is brilliant for the user, but it raises a catastrophic question for OpenAI's balance sheet.
How so?
If the industry shifts to these hyper-efficient models that use a mixture of experts and spend their time deliberating on local devices, your laptop, your company's internal server, or your smartphone, does OpenAI's massive bet on $3 trillion global data centers suddenly become a stranded asset?
Wow, stranded assets, like building a million massive shopping malls right as Amazon invents 2-day shipping.
Exactly. If you commit $100 billion to building massive brute force supercomputers, and the software industry figures out how to get the exact same, or better, results on a server a fraction of the size using smart routing and deliberation, your infrastructure is obsolete before you have even paid off the interest on the loans.
That is wild.
You have poured billions into concrete and specialized chips that no one needs anymore because the software got smarter than the hardware.
Here's where it gets really interesting, because that tension, the tension between the astronomical cost of building the technology and its actual utility when it hits the real world, brings us directly to the businesses that are actually trying to use it. Let's look at the enterprise reality check.
This is where the rubber meets the road.
We've talked extensively about the builders and the structural rot in their financing. Now let's talk about the adopters. You know, the Fortune 500 companies, the logistics firms, the hospitals. The data from the enterprise sector in 2026 presents what is essentially a massive adoption paradox.
The paradox is stark. According to recent surveys, nearly 90% of organizations are regularly using AI tools in some capacity. It is ubiquitous. You cannot find a Fortune 1000 company that doesn't have an AI initiative.
90%.
But the second half of that data point is the killer. Only 40% of those organizations can actually demonstrate a measurable positive impact on their earnings before interest and taxes, their EBIT.
For the listener, EBIT is just a fancy accounting term for operating profit. Basically, 90% of companies are paying for AI, but only 40% are actually making more money because of it. That means the majority of companies are just setting cash on fire.
Exactly. The ROI gap, the return on investment gap, is the defining enterprise story of 2026. Businesses went into this transition in 2023 and 2024, targeting a 20% return on investment for their AI initiatives. They thought it was a magic bullet for productivity.
And the reality?
They were averaging only a 10% return. And for a massive swath of the market, the return is literally zero. The MIT Media Lab noted that despite $30 to $40 billion in enterprise investment poured into generative AI integration over the last few years, a vast majority of organizations are getting zero net return. The costs are eating the productivity gains entirely.
So the obvious question is, why are they failing so badly? If the technology is supposedly so smart, why can't a multi-billion-dollar corporation make it work?
It comes down to two silent killers that executives consistently underestimate: the cloud tax and dark data.
Let's unpack dark data, because I think anyone who works in corporate America, whether you are a middle manager or a CEO, will relate to this on a spiritual level.
Dark data is the bane of enterprise AI. It is the accumulation of decades of legacy, duplicated, unstructured, and often contradictory information sitting rotting in corporate servers.
It's the digital hoarding.
Exactly. It is emails from 2012. It is 5 different versions of a customer database. It is PDFs of contracts that were never digitized properly. When an executive board decides they want an internal AI to optimize their supply chain, they try to integrate a cutting-edge AI agent into a system built on terrible data hygiene. And what happens? The AI fails. It hallucinates, it makes catastrophic errors, or it simply can't find what it needs because the foundational data is garbage.
It's the classic garbage in, garbage out problem, but on a trillion-dollar scale. I always think of it like that one shared drive folder every company has. It's labeled final_presentation_V4_really final_do not delete.
Oh, absolutely. Every company has that folder.
It's got files from people who left the company 6 years ago, and no one wants to touch it because they are afraid of breaking something. Imagine feeding a decade of that chaotic mess into an AI and expecting it to write your Q3 financial projections. It is no wonder it hallucinates. But fixing that is expensive, right?
Incredibly expensive. Which brings us to the second killer, the sticker price fallacy. Companies budget for the AI licensing fee. They think, okay, it's $30 a month per user for Microsoft Copilot.
Seems reasonable.
But they completely fail to budget for the hidden, massive costs of data hygiene cleanup, hiring the specialized data engineers to structure that dark data, and the sheer cloud computing power required to run these models on their internal networks.
The cloud tax.
Yes. As a result, companies are experiencing a 30 to 50% overspend in their cloud computing costs. The cloud tax, just trying to get the AI to stop hallucinating and actually work. They're bleeding money to Amazon AWS and Microsoft Azure and getting very little operating profit in return.
But wait, we can't ignore the 40% that are succeeding. The companies that are actually moving the needle on their operating profits, they aren't just plugging a generic chatbot into their corporate intranet and hoping for the best. If we look at how businesses are actually navigating this successfully, there is a clear pattern. They have made a tactical, fundamental pivot from training for the tool to workflow redesign.
That is a crucial distinction. Can you explain the difference for the listener?
Absolutely. The companies failing are asking a flawed question: how do we use this new AI tool to do this specific old task? That's training for the tool. You're just trying to make a bad process slightly faster. The companies winning are asking a totally different question: how does this entire workflow change fundamentally now that AI exists?
They're redesigning the actual work.
They are tearing the process down to the studs. And that mindset shift is driving the rise of what we call agentic AI.
This is a major buzzword in 2026. How does an agent differ from a standard generative AI chatbot?
A chatbot requires you to constantly prompt it. You ask a question, it answers. You ask another question, it answers. An autonomous agent is completely different. Gartner is predicting that 40% of enterprise applications will embed task-specific autonomous agents by the end of 2026.
40%.
That is up from just 5% in 2025. These aren't just autocomplete tools. These are software entities that can plan a multi-step process, use external tools like web browsers or calculators, store long-term memory about a project, and act independently toward a goal you set for them.
Give me a concrete example.
You say, research our top 3 competitors' pricing changes over the last year and draft a memo, and the agent goes off, browses the web, pulls the data, creates a spreadsheet, writes the memo, and emails it to you an hour later.
It is the shift from a tool you wield to a digital employee you manage. And it's not just software. We are also seeing the rapid rise of physical AI, the integration of these models into robotics and digital twins. Currently, 58% of major industrial and manufacturing companies are now using physical AI to optimize real-world operations, like managing warehouse logistics or predictive maintenance on assembly lines.
And if you want to see where this workflow redesign is actually justifying these massive valuations, where the ROI is undeniable, you have to look at the healthcare sector. It is the great glaring exception to the ROI gap right now.
It truly is. The data from Bessemer Venture Partners on health AI is staggering. They've coined the term the health AI X factor, and it perfectly illustrates what happens when AI meets a sector plagued by administrative bloat.
Explain the X factor, because the velocity of these companies is breaking all the traditional rules of software investing.
Historically, if you started a legacy healthcare software company, say building a new electronic health record system, it might take 10 or more years of grinding sales cycles to reach $100 million in annual recurring revenue, or ARR. The friction was immense.
Getting hospitals to buy software is notoriously hard.
Yes, but today, health AI companies that are automating medical coding, patient intake and prior authorizations are hitting that 100 to 200 million ARR mark in under 5 years. They are growing more than twice as fast as the best software companies of the previous decade.
Why? Because the friction they're removing was so high. Healthcare administration is basically one giant pile of dark data and inefficient workflows. And we are seeing major structural catalysts hitting in 2026 that will pour gasoline on this fire. For example, CMS, the Centers for Medicare and Medicaid Services, is launching formal experiments this year to establish clinical AI payment codes.
That cannot be overstated. That is a total game changer for the industry.
Exactly. Up until now, a hospital might use an AI to help triage patients, but they couldn't directly bill insurance for the AI's time. CMS creating payment codes means medical providers can actually get reimbursed by the government for using AI for risk assessment or diagnostic assistance.
The moment you tie AI usage directly to hospital revenue, adoption goes vertical.
Vertical. We are also seeing the explosive rise of what are called digital CROs, or contract research organizations, in the pharmaceutical space.
This directly addresses what the pharma industry calls the R&D trilemma, balancing cost, speed, and competitiveness.
Right. Developing a new drug traditionally takes billions of dollars in a decade of physical lab testing, with a 90% failure rate. These new digital CROs use AI to computationally model how millions of potential drug molecules will interact with human proteins.
They simulate the process.
They can predict toxicity and efficacy in a computer simulation before a scientist ever touches a physical petri dish or tests on an animal. They're cracking the R&D trilemma by simulating clinical trials digitally, saving literally years of time and astronomical amounts of money.
It is a profound shift, and it is undeniably saving lives and capital. But, and this is where the realist perspective has to step back in, implementing these autonomous agents, these digital clinical trials, and these robotic warehouse managers isn't just a technology problem. It is fundamentally a human problem.
Right, the impact on the workers.
When you change workflows that drastically, you inevitably change what human beings do all day. And in many cases, you eliminate the need for those human beings entirely, which leads us directly into the massive societal labor market impacts we are seeing.
That is the perfect bridge. We have to look at the workforce reconfiguration. Are we looking at augmentation, where AI just makes human workers faster and more productive? Or are we looking at mass displacement, where humans are simply replaced? The labor market data right now is incredibly messy. It is showing two very different realities depending on whose research you read.
The contradiction in the data is jarring. Let's look at the Brookings Institution data first. They are taking a very measured historical view. They state quite clearly, there is no AI jobs apocalypse happening yet. To them, AI is acting as a normal technology.
What do they mean by a normal technology?
They mean it is behaving like the introduction of the personal computer or the spreadsheet. It's taking time to adopt. Companies have to re-engineer those workflows we just talked about. They have to clean their dark data. They have to train staff. Because of this friction, the immediate impact on the labor market is a gradual evolution, a shifting of tasks, rather than an overnight cliff where millions of people are fired on a Friday.
Okay, that sounds comforting. But you have to contrast that measured academic perspective with the real-time reporting from organizations monitoring actual mass layoffs. If you look at the tracking data compiled by groups like the World Socialist website, the picture is incredibly grim.
What are their numbers showing?
They aggregated the numbers and showed that at least 127,000 tech jobs were lost in 2025. And the bleeding hasn't stopped. Another 30,000 were slashed in just the first couple of months of 2026 alone.
And these aren't just small startups.
No, we aren't just talking about tiny startups running out of venture capital. We are talking about Amazon cutting 30,000 corporate roles. We are talking about UPS cutting 48,000 jobs. And they explicitly tied those cuts to the introduction of automated hubs and AI-driven routing systems.
So how do we reconcile those two dramatically different viewpoints? Brookings says there is no apocalypse, while the layoff trackers show hundreds of thousands of jobs vanishing into thin air, specifically blaming automation.
Right. How do you square that circle?
You reconcile it by looking impartially at the class and age dynamics of exactly who is losing their jobs. It is not an even distribution. The Dallas Federal Reserve published some incredible granular research on this recently. They found that AI is currently acting as a direct substitute for entry-level workers, but it acts as a complement or an augment to experienced workers.
Break that down. Why does age and experience dictate whether you get replaced or promoted?
It comes down to the type of knowledge required for the job. If an AI can perfectly replicate codified textbook knowledge, the kind of things you learn in your first 2 years out of college, like basic coding syntax, drafting standard legal memos, or formatting financial spreadsheets.
The grunt work.
Exactly. But it cannot replicate tacit experiential knowledge, like knowing which legal strategy is best for a specific temperamental client, or navigating complex office politics to close a deal. So the jobs that just require processing basic information are gone. They're easily automated by an agent.
Which means the entry-level job ladder is fundamentally broken.
Completely shattered. The real insight here isn't just that an AI can write a spreadsheet faster than a junior analyst. It's that the traditional corporate apprenticeship is dead. Used to do grunt work for 3 to 5 years to learn the business, understand the industry context, and build relationships.
Right, that was the path.
If AI does all the grunt work, how does a 22-year-old ever gain the tacit experiential knowledge required to become a 30-year-old manager? They don't. The Dallas Fed noted that under 25s are facing a massive, silent hiring freeze in heavily AI-exposed sectors like marketing, junior software development, and administrative finance.
That is a terrifying prospect for anyone graduating college right now.
And there's a deeper, more cynical layer to this. There is a very real critique emerging that corporations are using the promise of AI productivity as an ideological cover to enact massive structural changes they wanted to make anyway.
Oh, interesting. Using it as an excuse.
Yes. They are using this moment to flatten management structures and squeeze the remaining workers to do more with less. They announced 10,000 layoffs and tell Wall Street it's due to technological efficiency and AI integration, whether the AI actually replaces that specific human output or not. It provides a convenient, futuristic excuse for old-fashioned cost-cutting.
That is the grim, pessimistic reality for entry-level corporate roles, and I cannot dispute the pain those workers are feeling. But let me bring in the tactical perspective from MIT Sloan and LinkedIn, because if we only focus on the destruction, we miss the creation. There is massive opportunity forming on the other side of this disruption for those willing to pivot. What kind of opportunity offsets the destruction of the entry-level corporate ladder?
Well, let's look at the MIT data. Yes, their research shows that high-paying cognitive roles like management analysts, certain types of aerospace engineers, and financial analysts are shrinking by about 3.5% within firms that are heavily adopting AI. The tasks are being automated. But, and this is the crucial part, those specific firms adopting AI are growing their overall revenues and their overall headcounts significantly faster than their peers who aren't adopting AI. The firm gets bigger and hires more people overall, which offsets the specific role losses. They're just hiring different types of people.
Different types of people. That is the key phrase.
Exactly. LinkedIn's 2026 labor market report identified 1.3 million new, specifically AI-enabled jobs globally that didn't exist in meaningful numbers 3 years ago. We are talking about roles like AI integrators, data annotators, prompt engineers, and forward-deployed engineers. These are the people building and managing the agents. And this points to a massive cultural shift. We are entering what LinkedIn calls the new-collar era.
The new-collar era. Contrast that with the traditional white-collar path.
The traditional white-collar path was get a 4-year degree, get a desk job, push spreadsheets, become a manager. The new-collar path is entirely different. The U.S. Bureau of Labor Statistics estimates that by 2030, 60% of all new jobs created won't require a traditional 4-year college degree. 60%.
LinkedIn found that over 60% of workers in the U.S., and similarly high numbers across Europe, are showing a rapidly increased interest in technical trades over corporate office jobs.
That makes perfect logical sense. If the entry-level spreadsheet job is automated by Microsoft Copilot, the economic premium is no longer on being able to execute routine cognitive tasks.
Right.
The demand skyrockets for the person who can physically install the server racks, maintain the advanced cooling systems for the data centers, integrate these complex software systems into legacy hardware, or do complex physical work like advanced plumbing or electrical engineering that a language model literally cannot touch. It fundamentally changes what society considers a safe and lucrative career. Right. The plumber who understands how to integrate IoT sensors into a smart building is going to make more money than the junior financial analyst whose job got eaten by an algorithm. Which brings up this incredibly vital concept of super agency. If you are a knowledge worker listening to this and you want to survive and thrive in this 2026 labor market, You have to undergo a mindset shift. You have to stop acting as an executioner of tasks.
Because the AI is the ultimate executioner of tasks.
Exactly. The AI will write the code faster. It will draft the email faster. It will crunch the numbers faster. You cannot compete on execution. You have to step up and act as an orchestrator of complex AI systems. You manage the team of autonomous agents. You provide the strategic vision, the ethical reasoning, the complex human negotiation required to close a deal, the empathy required to manage a client's anxiety.
The distinctly human skills.
Yes, you lean into the distinctly human power skills. You become the human-in-the-loop expert, the super agent who guides the machine output toward actual business value.
If we connect this to the bigger picture, this disruption in the labor market, this broken entry-level ladder, the anxiety of the squeezed middle management, and the massive shift to the trades does not happen in a vacuum. It feeds directly into societal instability and political pressure, which brings us to the global stage. We have to look at how governments are reacting to this upheaval.
That brings us perfectly to the final massive piece of this puzzle: regulation, sovereignty, and geo-economic confrontation. Let's be unequivocally clear about the reality of 2026. The era of optional, self-policed AI governance is officially over. The Wild West days are done.
And it didn't happen the way people expected. For years, everyone watched the federal government expecting a sweeping nationwide AI bill. But with comprehensive federal laws largely stalled out due to partisan gridlock, the state attorneys general looked at the labor market disruption, looked at the privacy risks, and simply stepped into the vacuum. They have taken over.
And they are moving aggressively with real teeth. We are seeing laws that move from vague theoretical guidelines about fairness to actual enforceable technical compliance. For example, the Colorado AI Act becomes fully effective in June of this year, 2026. It mandates rigorous, ongoing risk assessments for any high-risk AI systems.
Define high risk in the context of the Colorado law.
High risk means any AI used to make decisions that significantly impact a human's life. We are talking about AI used in employment screening and hiring, housing applications, or financial lending and credit scoring. They are legally demanding that companies prove with auditable data that their AI isn't discriminating based on race, gender, or age.
That's a huge compliance burden.
Yes. If your AI agent rejects a loan applicant, you have to be able to explain exactly why it did so mathematically. Meanwhile, California's AB 2013 is attacking the intellectual property side. They are requiring deep transparency into the training data used for these massive models, forcing companies to disclose if they scraped copyrighted material to build their billion-dollar systems.
And the tactical problem for businesses right now is that they are totally, woefully unprepared for this regulatory cliff. Current enterprise data shows that a staggering 80% of companies lack mature, established governance frameworks for the agentic AI they are already aggressively deploying.
It's terrifying. You have these autonomous agents running around corporate networks, making independent decisions, accessing databases, and drafting emails, and 80% of companies have no compliance structure to monitor them or shut them down if they violate Colorado law. They are walking into a massive liability trap.
This lack of internal governance feeds into much broader, much more dangerous global anxieties. The World Economic Forum released their highly anticipated 2026 Global Risks Report, and it is telling. The number one risk identified by global leaders isn't climate change, it isn't a new pandemic, and it isn't even rogue AI itself. It is geo-economic confrontation.
Geo-economic confrontation, that's a sterile term for a very messy reality. We are watching a profound, accelerated tech decoupling between the United States and China.
It is a race for technological sovereignty. The U.S. is fighting desperately to maintain total sovereignty over AI infrastructure and chip manufacturing. This has led to massive, sweeping U.S. tariffs on non-AI goods, particularly from Asia, to protect domestic industries and theoretically generate revenue to subsidize domestic tech manufacturing. But tariffs are essentially a tax on the consumer. They are causing widespread inflation on everyday goods.
Which hits the lower and middle classes the hardest.
Exactly. They are being passed directly onto the consumer at the checkout counter. The result of this policy is a deeply entrenched K-shaped economy. The top arm of the K is pointing up. The tech elites, the venture capitalists, the orchestrators with super agency, and the executives in the AI boom are thriving. They are seeing unprecedented wealth creation.
And the bottom arm.
The bottom arm of the K is pointing down. The middle and lower classes, the entry-level workers whose jobs are automated, are being squeezed simultaneously by tariff-driven inflation and a stagnant, disrupted job market. It is a recipe for immense domestic and geopolitical friction.
But again, if we look at how businesses are actually navigating this realistically, how do you operate in a K-shaped economy with fractured state laws? You have to completely change your mindset regarding compliance. You have to stop viewing regulatory compliance as a legal burden, an annoyance, or a tax on innovation. The companies that are actually winning enterprise contracts in 2026 are treating AI compliance as a core operational discipline.
They are weaponizing compliance as a competitive moat.
Precisely. If you can prove to a Fortune 500 client that your AI agents are governed, secure, explainable, and fully compliant with the Colorado AI Act and California AB 2013, that becomes a massive competitive advantage. You win those lucrative enterprise contracts because the other startups, the ones who move fast and break things, are simply deemed too legally risky for a major bank or hospital to partner with. Good governance is good business in 2026.
That is true. But even the most perfectly compliant, efficiently run company is ultimately at the mercy of the macroeconomic tides. Which brings us full circle, back to Ray Dalio's capital war thesis that we touched on at the very beginning. We mentioned Bridgewater's defensive pivot. Dalio is pointing out the ultimate systemic vulnerability. The United States is currently sitting on $35 trillion in national debt.
It's a number so big it loses meaning for most people, but how does that debt tie back to the AI infrastructure boom?
It ties back directly through the bond market. If geoeconomic confrontation worsens, if those tariffs spark a trade war, or if foreign buyers spooked by U.S. sanctions simply decide to stop purchasing U.S. Treasury bonds, then the demand for U.S. debt drops. When demand drops, Treasury yields have to spike to attract buyers. If yields spike, the baseline borrowing costs for the entire economy go through the roof.
And suddenly that $3 trillion AI infrastructure build-out we talked about earlier hits a brick wall.
Exactly. The entire AI capital expenditure boom. OpenAI's Stargate, the massive new data centers in the Midwest, the semiconductor fabs in Arizona, relies absolutely on cheap, accessible debt. If a capital war erupts and borrowing costs skyrocket, that funding freezes. The concrete doesn't get poured. The chips don't get bought. A capital war stops the AI infrastructure boom dead in its tracks, regardless of how smart the models are.
So we have pulled a lot of heavy, complex threads together here. We've looked at the macroeconomic stock market predictions and the fear of a crash. We've peered into the financial black hole of building these models at OpenAI. We've done a reality check inside the enterprise, looking at dark data and the incredible success of health AI. We've analyzed the deep upheaval in the labor market, death of the apprenticeship, and the rise of the super agent. And we've looked at the geopolitical risks of tariffs and capital wars. So what does this all mean?
We have to synthesize all of this.
Yes, let's synthesize our takeaways. The core question we started with, is the multi-trillion-dollar AI bubble collapsing into zero? The answer we are seeing consistently across all these sources, from Goldman Sachs to the Dallas Fed, is no. It is not collapsing to zero like pets.com, but it is experiencing a radical, painful deflation. We are transitioning out of a period of blind euphoria, that era in 2023 and 2024, where any startup with .AI in their domain name got $1 billion valuation, into an era of ruthless ROI reality checks and extreme investor discipline. The market is violently separating the infrastructure builders from the companies actually generating sustainable revenue with the tools.
The foundational technology is undeniably real, and it is permanent. The models can do incredible things, but the massive financial structures, the circular financing loops, and the shadow banking debt built around it in the last 2 years were largely speculative and, in many cases, mathematically unsustainable. The correction is stripping away the fantasy to find the actual utility.
Exactly. So for you, the listener, the takeaways are intensely tactical. Whether you are trying to figure out where to allocate your 401k and looking closely at the adopters over the builders, whether you are a young professional looking at a frozen entry-level job market and deciding to upskill into a super agency orchestrator role, or whether you are a business leader trying to untangle cloud sprawl, clean your dark data, and implement agentic AI, the absolute mandate for 2026 is quality over hype. You have to demand proof of value. Look for the adopters, look for the companies successfully executing workflow redesigns, and look for sustainable, legally compliant governance. That is where the value lives in the deflationary era.
And as we close this deep dive, I want to leave you with one final structural thought to mull over, connecting the technology to the physical world. We talked at length about the DeepSeek moment and the shift towards smaller, hyper-efficient models like mixture of experts that use inference-time compute. These are models that can think natively on local devices, your phone, or a small corporate server without constantly needing a massive, centralized server farm.
If the software industry is rapidly, aggressively evolving away from brute force scale and towards decentralized efficiency, what happens to the trillions of dollars currently being poured into building massive, energy-hungry global data centers? Could the massive Stargate infrastructure we are rushing to build today, funded by unprecedented levels of private debt and straining local power grids, become totally obsolete before the concrete even dries?
That is a chilling and incredibly important question to keep an eye on as we move through the rest of the year. Are we building the cathedrals of the future, or are we just building the world's most expensive empty shopping malls? Thank you all for joining us on this massive exploration of the 2026 landscape. Please remember one last time to subscribe and like Surviving AI with Carlo Thompson so you can stay ahead of these trends. Keep learning, stay curious, and we will see you on the next deep dive.